Hey everyone, in today's video, I'm going to be talking about 4 dividend stocks that I'll be buying throughout the month of June 2024. We're going to talk about what these stocks are, going over some background on each of these stocks before talking about their valuation and why I'm looking to add them in my portfolio this month. If you like this kind of content, be sure to give this video a big thumbs up. It helps a ton with the channel, and also consider subscribing if you like this kind of content as well. Okay, diving right into the first stock here. It is ticker QSR, Restaurant Brands International. This stock trades both on the Canadian and the US stock exchange. We're looking at the Canadian ticker right now. But this business owns brands like Burger King, Tim Hortons, Popeyes, and more recently, they also own Firehouse Subs. And they're mostly a franchise business, which we'll get through in a couple minutes. You can see in the last year, this one's down about 9%. Past 5 years, it's been on a wild ride from over $100 pre-pandemic, had some tough times, bounced back pretty quickly over the last handful of years before having a bit of a down trough in the last handful of months. That's primarily been between the sentiment of lots of these fast food chains having a lot less traffic coming in the doors and trouble attracting new guests as the prices have just gone up and fast food is not as cheap as it once was. So it's lots of interventions going on right now. You saw the Burger King and the McDonald's $5 value menu that they're rolling out currently to try to get some of that foot traffic back. We'll see how it pans out, but that's kind of the reason why this more recent dip in the last month or so, you can see 8% gone there. Total market cap on this one about $44 billion. They paid 3 to 4% dividend yield. Looking into their business a bit more, like I said, Burger King, Tim Hortons, really the bigger part of their business. And even though Burger King is the much larger overall network globally, they have it mostly franchised out, where Tim Hortons, they actually own a chunk of the restaurant still. So from a realized revenue standpoint, Tim Hortons, I believe, is still the most important part of the business, followed by Burger King, then followed by Popeyes. And then Firehouse Sub is still kind of a project that they acquired for $1 billion a couple of years ago that they're currently building out to more markets. And one of the things with this one and how they've purposely called themselves Restaurant Brands International is lots of their growth runway is really driving franchises in an international market. So you can see the gap in restaurant count versus what they think they can achieve. And it's just huge, the opportunities they have overseas. You see almost 50,000 restaurants that they feel like they can get to in Asia, another 20,000 in Europe, Middle East and Africa, 10,000 in Latin America, and then in their home continent here, still 44,000 that they feel like they have a good opportunity on in terms of the runway for expansion. This is how they kind of look at by brand the opportunities they have, and it's interesting to see how they have this kind of 7 to 10 year plan to drive restaurants from or markets from signing into the brand to having a developed business there. So you can use Tim Hortons as an example. They're looking to sign in Indonesia, Malaysia, Panama, bring the brand there for the first, that'll take 2 years. Then for the first few years, they'll, develop those markets and build awareness with the consumers there and maybe offer specials, trials, roll out the app, stuff like that. Maybe learn from the consumers there, have unique menu offerings, and that's what they call the entry phase. You can see some of the markets they feel like they're in that. And then once they feel like they figured it out, they'll start scaling up. And you can see here in the entry phase, they just have a handful of restaurants between 2 and 20. And then when they scale up, they get to 50, 100, 120, those kinds of numbers here. And then they kind of have sustained growth where they're operating it like a developed market. So I found it interesting how they kind of lay that out on each of the brands. And it really goes to show how this is kind of the core value creation model for the company is really not only how do we drive same store sales growth, which is obviously super important for these restaurant brands, but also how do we just increase the size of the pie by getting into more markets, not on just one brand, but on all of these brands. So I love to see this. At the end of the day, every restaurant that opens up globally is a new profit center for Restaurant Brands International. They have more licensing fees, more royalty revenue coming into the organization that they can then redeploy to continue accelerating growth or pay out as dividends or share buybacks. Going into where they see the markets growing between now and 2027. So they have bakery and sandwiches. They're expecting to grow at 6%. Chain cafes, so this is probably more in the Tim Hortons realm, expected to grow at 10%. Chicken, so that's their Popeyes business, 7%. And then burgers, which is Burger King, at about 5%. So you can see they think Burger King probably has the lowest absolute runway in terms of the overall category growth. But they're making a lot of investments there to try to outpace the category on burgers and on beef. So here's a couple things they're doing. One thing they're doing is they're investing a ton of money to modernize the image of Burger King in the US. The US burger market is extremely competitive. Obviously, it's McDonald's home market. They're the kings, and they've invested lots of money in turning around and renovating their franchise network. Burger King hasn't been as successful and is kind of behind on doing that. So they've put forward a commitment to get 90% of their US stores into renovated Burger King concepts by 2028. And to show how serious they are about that, they actually acquired the largest franchisee of Burger Kings in the US. I believe this business, Carol's Restaurant, owns over 1,000 Burger Kings, give or take. So by owning those themselves, they're going to be able to make those investments themselves, hopefully realize the upside in sales run rate that comes from those investments, and then ultimately refranchise them out to another company or spin it off. Because at the end of the day, they want to be asset light. They don't want to own all these restaurants into the long term for sure. So how have they been doing? Looking at their report over the last few years, you can see their system-wide sales growth. So this combines same-store sales growth as well as new store openings. You can kind of see here in 23, they had really strong growth across every single chain, 16% at Tim Hortons, 10% at Popeyes, 9% at Burger King, 20% international. And then looking how they grew on that, wasn't as strong. You had some weakness, like Burger King only grew 3%. Tim Hortons' growth rate pretty much got cut in half. Popeyes remained strong at 10%. But overall, these are pretty strong growth numbers in terms of absolute system-wide sales that they're realizing year over year here. And when we look at their valuation here, just to wrap it up, they're expected to do about $4.70 this year, which puts them just under a 20 times current year price to earnings. But if I was to look at next year at $5.30, that would put them at about a 17 times forward earnings on Restaurant Brands International. 17 times with that growth rate, with the diversification of having a chicken brand, a burger brand, a sandwich brand, a morning brand in terms of Tim Hortons, and all the runway they have on that international expansion. I think that's a great opportunity relative to lots of the other quick service restaurant chains that are trading well over 20 times earnings, less diversified, less runway for global growth, and less focused on that global international expansion. So that's why I really like QSR. The other thing about QSR that I like is, as a Canadian citizen, Canadian investor, I do like how I can buy it on the Toronto Stock Exchange. It alleviates that burden of FX fees as well as withholding taxes on the dividend that I'd have with like a McDonald's or Yum Brands or something like that. So it's definitely a nice little perk on top of the valuation being lower, on top of the built-in diversification. So lots to like here, in my opinion, and it's why it's one of the stocks I have on my buy list for June 2024. Going into the second stock here, it is Wyndham Hotels and Resorts. This is one that I just started buying over the last couple months. Have a very small position, but I'm looking to continue to increase it. Obviously, I've liked dollar cost averaging down, so wasn't in love with this 4% move up on Friday. But overall, year to date, this one's still down about 12%. There's been lots of moving parts on this one. It looked like they were going to get acquired by Choice Hotel Group rather, and they ended up fighting that off because they thought that their prospects were better to go on it solo. That did have some short-term headwind for the stock. In addition to that, it's been a lot of concern about the consumer and flight prices and everything else that has impacted the hospitality space. But ultimately, I think this one's in a good spot for the long term. You can see over the last 5 years, it's actually done pretty well still, up about 32%. This one trades at a $5.7 billion market cap. We're going to get to their PE at the end of the section. but they do pay a nice 2.1% dividend yield as well. I've talked about this one a couple times on my channel, so I'm not going to go into a huge amount of depth. Just want to show you the brands that they do own, and very similar to Restaurant Brands International, they are a franchising business. So they don't actually own any of these hotels. They just franchise them out. They get the royalty revenue, the licensing revenue to open them. And one watch out I always say when I'm showing this slide, even though it looks like they're very well diversified across economy, mid-scale, upper mid-scale, up into luxury, the vast majority of their doors and their revenue really comes from economy and mid-scale. This is where they have a ton of their franchises, and in addition to that, lots of the revenue in economy and mid-scale is in the U.S. So you really have to be comfortable of owning a U.S.-based economy and mid-scale franchising business if you want to buy this stock. Sure, they're global. They have an increasing amount of their new openings from outside the U.S., and they have an increased amount of their growth coming from these upper upscale areas of the hospitality market, but their core business today is still economy, mid-scale, and in the US. So just a bit of a watch out there in terms of if you're looking at investing in Wyndham stock with your own research. Looking at their pipeline. So obviously, similar to quick service restaurants or QSR, Restaurant Brands International, every single door that they open up, as long as it's sustainable and it's doing well, is a new profit center that they're getting royalty revenues off of. Very similar overall model here with Wyndham Hotels. So they're really planning on how can we grow our pipeline of total doors. They have 240,000 global rooms in their pipeline. That number keeps going up as they're looking at additional ways to expand their pipeline. A couple ways they're looking at building this out is with the extended stay category. They've built a brand called Echo Suites, which they're developing right now as a new concept. They also are signing on some new partnerships with other extended stay brands as they gain expertise and focus on that space. And you can kind of see global pipeline is up 8%, US up 5%. So they're really focusing on diversifying by outpacing the US with that global growth. This pipeline is in 60 plus countries. So they're really on the ball in terms of the pipeline and that being a focus area for how they're going to grow this business and their pool of revenues moving forward here. Going on, you can kind of see, I just like showing this chart. As I said, they're primarily, the bigger royalties that they get is really in the US. And I like showing this chart of where they are in the US. They're really across the entire US, obviously more heavily penetrated on the east side of the country as there's lots of nothing, for lack of a better term, in the middle here. But they span from the north to the south to the southeast to Texas and whatnot here. And they also have a decent presence here on the California side. And what they kind of talk about a lot is lots of their destinations are drive-to locations. They're not subject to flight costs to a large degree because lots of people are local Americans driving from city to city or destination to destination, which is really their bread and butter of their economy and those sides of their business here. And then one thing that continues to be important, even though they don't own the hard assets, they really need to make sure that their business and the return on investments of partnering with them makes sense for new franchisees who are looking to make investments and open up new doors. So this is just a look at how much it would cost, generally speaking, across the country to partner with Wyndham in terms of buying a hotel or opening a hotel with them if they don't already own their hotel. It would be an investment of $1.6 million. They'd get 70% loan to value on it at a 7.5% interest rate, give or take. So their net would be about $500,000 of earnings on that 1.5. They'd have to pay half of that to interest. They'd make $250,000 a year, which is about a 16% return on their investment. So the higher this cash on cash return gets, the more acceleration they get in people wanting to enter this business, become entrepreneurs, open family businesses, partner with Wyndham and partner with other franchising hotel chains and whatnot. So this is a really important number because if this starts going lower, interest rates get higher, cash on cash returns now 12, 11, 10%. Why would someone take all the effort and do this when they can do other alternatives that may get them slightly less return, but for way less time and commitment. So this is something that they publish every quarter. I've seen it go as low as 15%, I think, as high as 20%. So it's on the lower end with interest rates where they are, but it's something that I do like to monitor. And even though the company as itself may not be overly hedged to interest rates or overly hedged to the economy in a very short span of time, all of their owners and operators are. So it's still an important aspect of the overall business here. In terms of their capital allocation strategy, this is a very shareholder friendly company. It's one of the reasons I really like the business here. They return tons of excess capital to shareholders. They pay a dividend rate in the 30s, so they have 2/3 of their free cash flow to spend on other things, and they increasingly are spending that money on share buybacks. So we'll go through that in a minute, but they do return tons of their capital to shareholders that they're getting so passively through these income streams that they've created. The other thing is they want to continue to maintain a strong balance sheet, 3 to 4 times debt range, and their current leverage right now is at a 3.4 times. So right in the middle of that level that they're targeting right there. So no increased investment needed on that. In terms of investment in their business, they're really looking to drive higher RevPAR rooms and mid-scale plus hotel chains. So this is what I was showing that chart at the beginning here. They're really looking at how can we build out these chains or acquire new chains in this area. Recently, they've bought Vienna House, which is a small kind of boutique hotel chain in Europe. Waterwalk is, I believe, an extended stay. I need to double check on that, but they've added a couple upscale ones. They're looking at continuing to outpace their economy and mid-scale openings with the upper mid-scale upwards, for lack of a better term, openings to drive higher daily rates per room. And that's kind of what they're talking about investing in here with some of their cash flows to accelerate that move. And in terms of the shares, you can see here, just 5 years ago, they had about 100 million shares. They currently have about 80 million. And every year, for the most part, they've been lowering and lowering this share count. I expect next year to be under 80 and then it to continue to go down from there, which is a real force for growth on the overall share count, since they have such a straightforward cash flow number that they represent on the company, and it's super consistent quarter after quarter, given the nature of the business. It's really easy to see how lower share count will increase the cash flow per share, which will ultimately put upwards pressure on the stock price there. Looking at their earnings here, you can see about $4.20 this year. So on this year, they're currently trading at about, doing math in my head here, but about 17 times earnings. And then next year, they're looking to grow almost 10%. So this stock's trading 15 to 16 times next year's earnings here for a company that has a really nice pipeline, continues to buy back shares, pays a nice dividend. And I just think that this is a similarly great opportunity as long as the economy holds at a good pace. I think they're going to have a good chance to open these stores, hold or increase average daily rates across their network. It's going to be a lot of tailwinds to the share price in addition to just the buybacks that they're doing. And it's why at $70, under $70, I do really like this name, and it's one that I'm adding to my portfolio. Going into the third stock here, it is Dream Industrial REIT. This is a REIT that's operated out of Canada. You can see 5.7% starting dividend yield paid out on a monthly basis. They own industrial properties across Canada and in Europe as well. So they are pretty diversified in terms of the areas they play in. And unlike lots of other areas of the REIT segment, they actually are in an industry that's fundamentally growing. More and more demand for industrial real estate is popping up across the world as e-commerce takes off, as these big population centers get bigger and they need more warehouse space on the outskirts of the cities to serve all of the users and consumers that live in these cities. So I do really like the underlying fundamentals of the industrial real estate category. I do like the starting yield at 5.7%. In addition to that, they have been growing their funds from operation. I believe last year they went from about 83 cents a share to 90 cents a share, give or take. So this stock's trading at about 13 and a half times last year's funds from operations, probably about 13 times or lower this upcoming year's funds from operations estimates, if I was to guess. So not a super expensive valuation for an industry that's been growing their rents at a pretty good clip and are really well positioned with long-term tenants in place. Just to look at some of their facts here, 35% total debt to asset ratio. So that's a pretty decent number there. They have a 97% occupancy rate, 10% funds from operation per unit growth. That's the number I was alluding to just a few minutes ago. And if you were to look at their actual net asset value per unit, it's really at about $16, $17. So they're trading at a 20-30% discount to what their actual underlying real estate value is. Now, I always like having a nice buffer because I don't know how up to date this is, or the market hasn't been overly liquid, so maybe this is overstating their net asset value a bit per share. But it is a nice thing to just keep track of and give me a bit of a margin of safety that they believe the net asset value is higher than the stock price is. And the other thing is you can kind of see the sustained growth they've had in their net asset value over the last 7 or 8 years, which kind of like makes me feel good about just the industry and the category of industrial real estate as a whole. Going down here, you can kind of see they're pretty well diversified in terms of the industries they have exposure to. Obviously, logistics 20%, consumer goods and food and beverage 20-30% there. Diversified industries, residential, auto, paper, printing, packaging, technology. Lots of these businesses, like light industrial here, 19% of their operation is people that actually have office space, and then they have the plant in the back, and it's like a hub for the entire business to operate out of. Lots of these medium-sized businesses that operate on the outskirts of major cities there. Then you can kind of see their rent by size. So over 100,000 square feet is half of their rent. These are huge, huge facilities that primarily are being rented out by probably Fortune 500 companies around the world. Think Amazon, DHL, FedEx, companies like that. So this company, in my opinion, is in a good spot. They have a fair valuation for the rate that they're growing at, and it's one that I wouldn't mind to have more exposure into. Just wanted to scan through here to give you a sense of some of the types of properties they own, or as you're passing this type of real estate, this is what you're owning with Dream Industrial here. This is a big center here, 447,000 square feet in Vaughan on the outskirts of Toronto. I think the one I opened here is actually all GTA, just because they have different decks for different areas of the world. But I just wanted to scan through to give you guys a general sense of, you know, the type of properties that that they own and the locations that they own it here. This one here is in Mississauga, 200,000 square feet there on 10 acres. Got some more here in Whitby here, 384,000 square feet, 24 acres. So you can kind of see on the map here where it is situated relative to the surrounding cities and stuff. So anyways, that's the third stock. Think that this is a good area to have commercial real estate in versus, let's say, office space, or I know retail has been under a bit more of a threat. But with retail, and it's a good transition into the fourth stock that I'm looking to buy this month, even though retail has kind of been a bit more dicey recently, really depending on where that retail real estate is, the valuations have come down to a huge extent. You can see here, before the pandemic, Riocan trading 26, 27 times. That was about 15, 14 times earnings. Today, they're trading at 17.29. They're expected to do $1.80 plus of EPS, or funds from operations. So now the stock's trading at about 9.5 to 9 times funds from operations. They're paying a 6.5% dividend yield, and they've increased it a few years in a row now. And they've kind of implied they're going to continue increasing it slowly, 2, 3, 4% a year. So now I have a 6.4% company, yielding company, trading at under 10 times their earnings with a growth plan on their dividend and their funds from operation. And I just think that this stock has wrongfully got tied up to the extent that they have in the commercial real estate sell-off, whether that be crappy retail or office real estate. But this company owns tons of flagship assets all over major cities in Canada, and their tenant base is ironclad. Before getting into that, I just wanted to show this. It's a lot of sentiment around retail being overbuilt in the US, empty plazas in the middle of the US going unused and stuff. One thing that's relevant is, in addition to the US being way overdeveloped on e-commerce versus Canada, they also have about 60-70% more square foot per capita than Canada. Canada is underdeveloped on retail build out versus the US, which makes the supply-demand ratio much more attractive, and tenants having much less spaces to go and places to bargain off of each other like they do in the US if they want to enter the Canadian market. So that's one thing there just to keep in mind. Another thing here is just their tenant base. They've worked really hard over the last 5-10 years of having a very strong tenant base, 20% in grocery, pharmacy, liquor, 25% essential services, 12% in value retailers. Think Dollarama, HomeSense, Value Village. These are retailers that in a recession are not really going to have a challenging time. And then as it goes down here, you can see dine-in 10%, specialty 8%, QSR 8%. So lots of these things, they do have some maybe more cyclical businesses like furniture and home 5% and apparel at 5%. But generally speaking, the vast majority of their rent is coming from grocery and other areas of the economy that should be good no matter what happens. Going on here, you can kind of see their AFFO yield. Riocan here at 8.5% AFFO yield. So among the strongest yielding or undervalued, quote unquote, even within the REIT space on their overall valuations relative to their peers. So that's one thing I like to see. They're paying out lots of that yield to investors. And I think with the exception of maybe a couple of these like First Capital, they probably have one of the better quality portfolios, yet they're yielding near the top of the category, which is interesting to see. Another thing here, currently at 9.2 net debt to EBITDA, they're looking to get that in the range of 8 to 9. And from their earnings call last quarter, they feel like they're on track to achieve that in the next year. So that's good too for them to just deleverage a bit with interest rates where they are, but not looking to make any fundamental change to their leverage. They're almost there. They're going to get to that 8 to 9 range, which will help their debt ratios a bit, but then they're going to stay there and focus on investing in the business or buybacks or whatnot to create value. And then last but not least, lots of sentiment on some of the top retailers in Canada with big boxes that they need that Riocan has and is in short supply, looking to expand their presence, whether that's Loblaw, Dollarama, Canadian Tire, TJX. The more of these companies are looking for these limited boxes across the countries in these major cities, the higher the rents are going to go for them. And then those new rents are kind of going to be the standard. It's going to be a lot of upwards pressure on the rest of the boxes, even as other retailers look to renew. When you have all of these people and all of these different businesses looking to expand, it really gives Riocan a good hand going to those negotiations with their other tenants. So I think for a company trading at 9 times funds from operations here, with the interest rate backdrop that exists and a lot of potential downwards pressure on interest rates, which will create a lot of new free cash flow for Riocan as their biggest expense goes down, and their tenants still being pretty strong, I'll take 9 times earnings every day, take the 6.5% dividend yield, and kind of wait for shares to correct and funds from operations to trend up over time, given the portfolio that they've built here. So those are the 4 dividend stocks I'm looking to add to my portfolio in June 2024. I hope you liked this video, especially if you made it to the end. Really appreciate it. Be sure to give this video a big thumbs up, and I'll see you guys in the next one. Thanks.